My next guest's December 6th report was entitled A Mandate for Deflation, which at the time, think about going into the presidential election. Both candidates were promising that, especially with regards to food prices. Moreover, according to a YouGov survey, 79% of respondents said that lowering the price of goods and services should be the top priority for President-elect Trump. So I want to bring in now Grant's Interest Rate Observer editor, Jim Grant. So, Jim, listen, the news is out, the market's moving down just a little bit, not just a little bit, maybe a little bit even more hawkish than Wall Street thought. The Fed sort of changing its tune a little bit here.
Yeah. Charles, I simply don't know. I think that sometimes markets go down at very, very inconvenient moments, but it does happen.
And your report was intriguing in the sense that deflation, there's a big difference between disinflation and deflation, right? We've seen disinflation where the rate of growth of inflation has slowed dramatically. That's what people want. That's what economists want to see.
Yes.
Main Street wants to see those prices come down.
Right.
And economists start to think about, well, what was the Great Depression really about? It was a death spiral, right? Because if you think an apple today that costs 10 cents, maybe 9 cents tomorrow, you're not going to buy the apple. And if you think it's going to be 8 cents after the 9 cents, you won't buy it tomorrow either.
Well, you mentioned Apple, which besides making fresh fruit also makes computers. A note that software and hardware have done nothing except plunge in price since the invention of the computer. So sometimes we get along with falling prices.
Right.
But wasn't this poll interesting? Such a preponderance of people saying that, we're not happy with a 20% rise in average prices since 2019. And they say they want prices cut. So economists are forever, preoccupied, if not obsessed, by the rate of change in the CPI. People say, no, I don't care. I want eggs back where they were.
Right.
And in a way, in a literal way, that's deflation. Deflation, I think, in a more important sense, is a phenomenon of debt destruction. That's where it gets its bad reputation. Now, in 1921, there was a depression in this country, 18 months.
Right.
And prices decidedly fell. But they fell along with wages. Companies regained their margins at lower levels of price and wages, and the 20s proverbially roared. So we are, we're guilty, all of us to a degree, guilty of presentism, right? What's happened yesterday or today.
Right.
But not me. You know why? Because I'm old.
Presentism for you was yesterday. So let's talk about the sort of dilemmas that you laid out there. The other thing, you wrote about repression. You said repression, here we come. And you noted the staggering amount of gross debt in this country. By the way, you had October's numbers. November was even worse. The government took in $629 billion. Spent $1.25 trillion for a $664 billion
That's
debt.
crazy, Charles.
so what was intriguing is you said, okay, there are 3 ways to potentially curb this.
Yeah.
Wholesome non-inflationary growth, wholesale non-inflationary growth, inflating the U.S. dollar, or financial repression. Yeah. And you think we'll go the financial repression route?
I think there's a risk of that. Let me try to explain. So what is financial repression? It is the Federal Reserve, for example, saying that interest rates shall be as follows, and to fix them. And they actually did that between 1942 and 1951, to start with the beginning of World War II and ending with the so-called Treasury-Fed Accord of 1951. So it's 10 years of the government saying what rates should be. It's a remarkable episode in our free market economic history.
Right.
So why would we need this today? Well, notice what has happened since the Fed began cutting rates in September. Have yields gone down? Nope.
Right.
and notice
up 85 basis points.
Right. And notice as well that I think debt service now constitutes like 52% of the deficit.
Right.
From like 20-something% in 2021. So one could imagine a state of affairs in which the country is looking at, if rates go up, growth slows, and spending increases, one could imagine a state of affairs in which 100% of the deficit is represented by debt service. So
100%.
that is a possibility
Right.
if the wrong things happen. But what that means is we are borrowing to pay to service our existing debts,
Right.
which is not a good look for a
That's
reserve
the
currency
war cycle.
country. Yeah.
Powell's going to be out in about 30 seconds. So your premise not long ago of potentially entering a secular bear market for bonds so far is holding up.
Yes, my look is 40 years out, and you will tell me at the end of that span whether I was right. But I think it's a framework for conceiving of the future in the light of the recent past in 2020 or 21, some $18 trillion worth of bonds priced to yield less. It was bond fever, right? Bond mania. And in markets, typically, excesses rebound in the opposite direction.
Already twice I've asked guests, American exceptionalism is the Achilles heel, our addiction to this government debt?
It's not America's exceptionalism in that respect. It is the state of affairs that is commonplace with paper money.
All right. Thank you so much, Jim.
Yes.